All right, good day. Hope that you're doing good. So in this video, we're going to be doing a previous exam question based on accounting paper one. Now, the first question is concept and accounting equation. So first, we're going to start off with our GAAP principle questions, whereby we need to match these descriptions on column A with these weights we are given on column B. Now, 1.1.1, it says, this principles means that the person drawing up the financial statements will assume that the business would continue to trade. Now, this is what we call going concern. So when you are an accountant and you're preparing financial statement for the business, you need to prepare them in a manner whereby you assume that the business would continue to operate in the foreseeable future. Now, for the first question, 1.1.1, this would be F. Now, 1.1.2, they said income generated during the particular financial period and the expenses incurred to generate the income for the period should be taken into account in that specific financial period. This simply means that if I received rent, let's say my financial year end, it's on February, and I receive rent up until March. Remember, I need to subtract that rent for March because I can only be able to receive rent up until February. So all your income as well as expenses, right? You need to recognize them for that particular year, meaning that you cannot receive income for more than your financial year. If your financial year is on February, you're going to receive income up until February, right? For that financial year. So what is this rule? This is your matching principle, right? Matching principle, it is that principle whereby they tell you that the income as well as the expenses for this year, you need to recognize them in this year's financial period. So the second one would be E. Now, what about the third one? According to this principle, information that is not important and that will not influence the decision-making process does not have to be reflected in the financial statements. E.g., expenses such as cleaning materials could therefore be included into account sundry expenses. So basically, this principle, it is your materiality principle. It simply states that any transaction which would not influence your decisions in the company should not be reflected on your financial statements. For example, let's talk about when you purchase the fixed asset. Because a fixed asset, it costs a significant amount. You need to show that transaction in your financial statements. Now, what if let's say you are running a retail store and you bought cleaning equipment? So do you think a person can make financial decisions based on how much cleaning equipment you bought during the year? Those kind of small costs that you incur, you need to classify them into a single group. And in most instances, they classify them under sundry expenses, right? So you create a group for those small expenses. And then with regards to big expenses, which can influence decision making in the company, you need to recognize them in your financial statements and you need to show them and name them. Just like your purchase of fixed asset, purchase of trading stock, those kind of large transactions are the ones you need to show in your financial statements, right? So as I've said, the second question is going to be D, your materiality. Now, 1.1.4, it says fixed asset purchased are recorded in the asset account, reflecting the amount that each asset originally cost. Now, this is your historical cost principle. Now, what is historical cost? Let's say now you buy a vehicle for 100,000 and that vehicle is worth 2 million. In your book, you're going to recognize it at an amount you bought it for, which is the 100,000, not how much it's actually worth. So basically, historical cost is telling us that any asset that you buy, you should recognize it at its cost, not how much it's worth, right? So this would be A, right? So I chose F, I chose E, I chose B, I chose A. So now I'm left with these two, business entity as well as prudence. Now, the last, it says, okay, money lost due to theft stock or theft of stock, it's written off, even though there is a possibility that it may be recovered in the future. Right now, this is prudence principle. So when there is something that is lost, even though there is a possibility that you may find that, you need to recognize that loss in your books. You need to show that there was something which was lost, right? So for the last one, this is going to be C. 1.2, which we're going to analyze transactions and we're going to write down their accounting equation. So first, my accounting equation simply states that my liabilities plus my owner's equity, they are equals to my assets. So every time whenever there is a transaction, you should ask yourself, what is it that that transaction affects? Does it affect your liabilities, your owner's equity, or your assets, right? And it is important to know that every transaction would have a debit as well as the corresponding credit, right? So it will have a debit account as well as your credit account. You just need to know which ones. Now, starting off with your liabilities, they increase on the credit side, right? Same applies with your owner's equity. They increase on the credit side, and both of them, they would decrease on the debit side. Now, with regards to your assets, all your assets would increase on your debit side and they would decrease on your credit side. Here they said, okay, the transaction appears in the books of Leo traders. The business maintains a gross profit markup of 50%. Now, what is gross profit markup? Now, gross profit markup, it's basically the percentage that you're making, percentage of profit you're making on every sale. Now, every time, whenever they give you a markup, this is the formula you need to go about using. So you need to say, when you take your cost plus your markup, this would give you a selling price. So your cost price plus markup, this is equals to your selling price. Now, let's try and analyze this in terms of percentages. Your cost price would always be 100%. Your markup would be given. In this case, it's 50%, meaning that your selling price, it will be 150. Right? Now, this formula is important and you would see why moving forward. So expand your markup formula to cost plus markup is equals to your selling price. Now, remember, cost is always 100. Markup here, we are given as 50, meaning that our selling price is going to be 150. Now here, okay, this is an example. The owner took goods for personal use, right? Now, what are the two transactions that are affected here, right? Let's try and do this example. So drawings. So when the owner takes drawings, right? Remember, personal use, when the owner takes things for personal use, this is drawings, and your drawings affects your owner's equity, right? So this would subtract your owner's equity by 500, by the way, this is supposed to. So this would subtract your owner's equity by 500. And what about the other account that is affected? Because they took what? Goods for personal use, which is trading stock. Your assets are your trading stock, right? They would also decrease by the 500 rands. So these are our two accounts which are affected: owner's equity as well as assets. Remember, the left hand side should be equals to the right hand side. As you can see, the left hand side is equals to minus 500, the right hand side is equals to minus 500. Now, which account would be debited, which account would be credited? Now, remember that your assets, which is your trading stock, would decrease by 500, meaning that your trading stock account, you would credit it. Here, we said your owner's equity, it decreases on the debit side, meaning that your owner's equity account is the one that is going to be debited, right? Now, but let's try and do these following transactions we are given. Now, your stores pay their account, which is a debt of 3,000, right, to a creditor. Now, basically here we are paying off a creditor. What are the two accounts that are affected? Remember, anything that has to do with a creditor would affect our creditor's control. So the two accounts affected, so let me write them here. Creditor's control, this would be the first account. The other account, because we are paying, and here, when we pay, remember, we pay using our bank account. So the other account which would be affected is our bank. Now, after classifying your two accounts, your first step, classify your two accounts, right? Let me write them here. Identify two accounts, two or more accounts that are affected. Let me put it that way. And you would see in which scenario you would have more than two accounts affected. So just to simplify this, whenever there are returns, right? Whenever there are any returns, this is where more than two accounts would be affected, right? But then in any other transactions, only two accounts are going to be affected. But when you have returns, this is where more than two accounts would be affected. And to be precise, with returns, four accounts would be affected. And remember, any other transactions, only two accounts would be affected. Now, after classifying your two accounts that are affected, step 2, identify whether those two accounts or those accounts, you need to identify whether are they asset account, owner's equity account, or are they liability accounts. And lastly, you need to, after you have identified whether are they asset account, owner's equity account, or liability account, lastly, you need to ask yourself which account would be debited, which account would be debited, and which account would be credited. Now here, I've classified my two accounts, which is creditors control and bank. Now, secondly, I need to ask myself that, okay, what is my creditors control account? Is it an owner's equity? Is it an asset or liability account? Creditors control is your liability account, and bank is an asset account. Right now, this is step 2. What about step 3? Identify which account would be debited and which one would be credited. So remember, I'm paying off a creditor. Now, when I'm paying someone, what would happen to my bank balance? Would it increase or would it decrease? my bank balance would decrease, right, as a result of me paying. Now, as a result, because bank is an asset, remember, it decreases on the credit side. So I would need to credit my bank account, meaning that, yeah, automatically I would need to do what? Debit my creditor's control account. And remember, when I'm paying off a creditor, what happens to that amount I owe them? It means that now I would owe them less money. So as a result, my liability account would decrease. Hence, I'm recognizing this on the debit side for my liability. So here, my two accounts affected are bank and creditors control. And remember, I said what? Which one am I going to debit? So here, now here, I said my creditors control account is going to be debited. So here, creditors control. And the corresponding debit, the corresponding credit account, it will be my bank account. Now remember, how much did I pay to this creditor? I paid them 3,000. So my amount here, 3,000. And now remember, bank is an asset. I said my asset is going to do what? As a result of me paying, my asset, which is bank, is going to decrease. So on my asset account, I'm going to say minus 3,000. And I said my liability, it's my creditor's control, right? And because I'm paying this data, this amount that I owe to them would also decrease. So my liability would decrease by 3,000. And as you could see here, if I were to write down my accounting equation here, assets is equals to owner's equity plus liability. My asset decreased by 3,000. My liability decreased by 3,000. And my owner's equity, it will be zero in this case. Now, as a result, can you see that the left-hand side, well, it's equals to your right-hand side? This is how you should be able to answer your questions relating to accounting equations. Now, let us look into the other transaction we are given. Now, the other transaction, they say a debtor return goods at a cost of 500 to the business. Now, remember I said whenever there are returns, there are going to be four accounts that are affected. Now, let me start with the first two, right? So when someone is returning something, or in this instance, a debtor, right? Whenever you have a debtor, the first account that will be affected is your debtor's control. And whenever someone is returning something, or to be precise, whenever your debtor is returning something, the other account that is going to be affected is your debtor's allowances. So allowances has to do with returns. If it was us returning to the creditor, this would have been creditor's allowances. So now the first two accounts are your debtor's control as well as your debtor's allowances. Now, most importantly, these two accounts, right, the cost that you're going to recognize on these two accounts should be in terms of selling price. Can you see here we're given cost price, not the selling price? Right? This is where we would make use of our markup formula. But make sure that these two costs are in terms of your selling price. Now, what is your debtor's control account? Right? So your debtors control account, it is an asset account, right? So your debtors control, remember your debtors are your assets. Now, if someone is retaining something to you, remember these are the people who owe you money. And if I owe you money, let's say I bought a phone for 500, I owe you and I took it on credit, meaning that now I owe you 500, right? When I return that phone to you, would I still owe you 500? No, right? As a result, your assets, which are your debtors, they would decrease. So here, your debtors control, identify the two accounts. Yeah, there are two accounts, and I say this is your asset account. And because it's going to decrease, this is going to be on the credit side. Now, your debtors allowances, what is your debtors allowances? This is your owner's equity, meaning that this needs to be on our debit side because that other one on the credit side, right? Now, these two must be in terms of selling prices. Now, what are the other two accounts that we need to classify? The other last two accounts, when you have returns by debtors that you need to recognize. So it is your trading stock, as well as your cost of sales account. So these are the four accounts always you need to recognize whenever you have returns, right? By customers to be specific. So now your trading stock account is an asset account. Your cost of sales account, it is your owner's equity. Now, whenever I'm returning something to you, right? Remember, trading stock is what you're selling. And if I return that thing to you back, would your trading stock increase or decrease? Your trading stock would increase, right? Because you would be receiving that trading stock that you sold before. So as a result, this would be debited. This account would be debited, meaning that our cost of sales account would be credited. Now, most importantly, these two accounts, the last two, they should be in terms of your cost price. The first two must be in terms of your selling price. The last two must be in terms of your cost price. Now, let us recognize this transaction in our books. So here, going here, I said for the first two accounts, when a debtor is returning something, you would have your debtor's control as well as your debtor's allowances. Here I said my debtor's allowances would be on the debit side. Debtor's allowances. And I said my debtor's control would be credited because now when a person is returning something to me, they would owe me less money. As a result, my asset would decrease, right? So here, debtor's control. Now, remember, I said these two must be in terms of the selling price. Now, what is our cost price we are given? Our cost price is 500. How would we find your selling price? You would multiply this by what you want always must be at the top. What you have always must be at the bottom. So on this formula here of your markup, what is it that you want? You're looking for your selling price, and your selling price in terms of percentages is how much? It's 150. So this is what I want. I'm looking for 150. What is it that I have? I have this 500. And what is this 500? This is the cost of my goods. And in terms of my percentage, my cost is 100. So I have 100. Now, punching this into my calculator, I'm going to find the selling price of these goods, right? And this should be equals to 750. This is how much, this is the selling price for these goods. So I'm going to write here, my amount is 750. And remember, I said, okay, my debtor's control is my asset. And as a result, because it's on the credit side, remember your asset, what do they do on the credit side? They decrease, right? So I'm going to minus the 750 on my assets. And my debtor's allowances is on my owner's equity. And remember, my owner's equity is debited and they decrease on the debit side. So my owner's equity should also be minus 750. This must be 0. So can you see that my asset is minus 750? This is equals to your other side, which is your owner's equity, which is also equals to minus 750. The right-hand side is equals to your left-hand side. Always make sure, right? Now, the last two accounts, which is your trading stock and your cost of sales, we said they must be in terms of your cost price. So my trading stock, I'm said whenever someone is returning something, because stock is going to increase and stock is an asset, trading stock should be on the debit side. So here, trading stock on the debit side. And on the credit side, I would have my cost of sales. Now, how much is my cost? My cost, 500. Now, because trading stock is an asset increase on the debit side, my asset would be plus by 500. And my owner's equity, they also increase on the credit side, as you could see here. Right? So remember, this applies to both your liabilities and owner's equity. So I would need to add my 500. So here, that's 500, 500. This would 0. Right. Now, let us move on to the next question. Now, 1.2.3, here we purchase trading stock on credit of 14,000 less 8% trade discount. Now, first, when we purchase stock, the first account that is going to be affected, because remember, the first step, identify your two accounts. What are the two accounts that would be affected? So here we are purchasing trading stock. So the first account, it will be your trading stock account. And because we are purchasing this trading stock on credit, the other account that will be affected is your creditor's control. If we purchase this trading stock cash, the other account that will be affected, it would have been bank. But here, because you are purchasing on credit, the account that will be affected is your creditor's control. Now, step 2, identify whether those accounts are the asset, owner's equity, or liability account. Now, your trading stock is an asset account. Your creditor's control, the liability account. Now, which account would be debited, which account would be credited? Now, when I buy trading stock, what happens to my trading stock? Does it increase or decrease? it increases. And remember, assets increase on your debit side. So this account would be the account that will be debited. Now, creditors control. When I buy something on credit, what happens to that amount that I owe to my creditors? It would increase, right? Meaning that I would owe them more. As a result, your liability account, remember, they increase on the credit side. So this would be debited, this would be credited. And I know that my assets would increase by how much? Let's say, oh, it's 14,000 less 8% discount. Now, let us calculate the amount as exclude the discount. So the normal amount we were supposed to pay is 14,000. And because they gave us an 8% discount, here I'm going to say 100 over 100. And here I'm going to minus my discount, right? 8. And this would lead me straight to the answer. But alternatively, what you could do, you could just say 14,000 and find how much is that 8% discount, right? So you could just say 14,000 multiplied by 8%. So this discount, basically, they are giving us, it's 112, right? And from there, because they say less discount, meaning that you need to subtract that discount, to take you 14,000, subtract 1,120. And as a result, the amount that would exclude your discount would be 12,880. Or alternatively, you could use this method, 100 minus your discount, all divided by your 100. So this would give you straight, or it would lead you straight to the answer, which is 12,880. So now, my trading stock, which is my asset account, it would increase by 12,880. My liability account, it would also increase by 12,880. So now to recognize the transaction, here, the two accounts that are affected, I'm going to write them here. Trading stock, this is the account debited. And the account credited, we said it's going to be creditors control. And how much is the amount? Our amount is 12,880. Our assets, which is our trading stock, we said is going to increase by this 12,880. And remember, your owner's equity would be 0. Your liabilities would be increased by this 12,880. Now note that in this instance, our assets, they increase by 12,880. Our owner's equity is 0. Our liabilities, they increase by 12,880. So still, the left-hand side is equal to your right-hand side, right? Meaning that we are in the right path. Now, doing the last transaction, a creditor charged interest of 25, right, of 25 rands on overdue account, which Leo stores had forgotten to pay in time. Now, what are the two accounts that are affected? Now, your two accounts, remember, anything that has to do with your creditor would affect your creditor's control. Creditor's control. What is that other account that will be affected, right? So remember, you are charged interest. So the other account that would be affected is your interest expense account. Or you could write it as an interest on overdue account, right? Now, let us classify whether these accounts, right, are they going to affect our assets, our owner's equity, or our liability? Now, creditors control. If the creditor charges us interest of 25%, is the amount that we owe to them going to be less or more? Going to be more, right? By 25 rands. Meaning that this, remember your liability account, and by the way, this is a liability account. And your interest expense, right? Because it's an expense, it would affect your owner's equity. Now, because the amount that we would be owing to this creditor, it would increase, right? So this account would be credited. And as a result, it would be added by the 25 rands. And this, your interest expense or any expenses, they decrease your owner's equity. Because remember, owner's equity, this is where you recognize your profits, right? And what do your expenses do to your profits? They decrease them. So hence this account it will be debited. Now, recognizing the two accounts, so if this is debited, this would be subtracted by 25, because remember this account decreases on the debit side. Now, if I were to recognize this accounts here, so on the debit side, remember I have my interest expense. So let me write it here. This is on the debit side. On the credit side, I have my creditors control. Now, what is that amount that I'm trying to, or the amount that I'm given in this transaction is 25 rands. Now, remember, I said the account that is going to be debited is my interest expense, which is my owner's equity. So my owner's equity would decrease by 25. My assets are not affected. My liabilities, remember I said this 25 rands is going to be added. So I'm going to add 25 here. Now, on my accounting equation, remember asset is equals to owner's equity plus your liability. I said my asset is 0. My owner's equity in this case, I said is minus 25. My liabilities, I said I'm going to add 25. Now, can you see that here, this would be equals to 0 and 0. Your left-hand side is still equals to your right-hand side, means that this is correct. And this is how you go about answering your accounting equation questions. Now, moving on to the next video, we're going to be doing the income statement, so make sure that you stay tuned.